Hello, everybody. I'm Mark Anderson. I'm a mortgage banker now with First Bank. At First Bank, I have the ability to provide mortgage loans in almost all of these great United States of America, with the exception of Maryland. Sorry, Maryland. One of the main reasons that I recently moved to First Bank was to access very competitively priced adjustable rate mortgages. And that is the subject of today's video. Number one, what is an adjustable rate mortgage, otherwise known as an ARM? Two, should you consider using an ARM versus a traditional fixed rate loan? And three, I wanted to talk a little bit about the kind of, let's call it a well-earned, scary, or negative reputation that adjustable rate mortgages earned in the lead up to the financial crisis in 2008. There's a couple myths I want to dispel, and there's a couple key differences with how ARM loans work today versus the way they worked back then. First up, I'm going to keep this as brief as possible because it's technical and boring, but there's some key elements that I think you need to know. When you are looking at an ARM product, you're typically going to see a product description that looks something like this. You've got a number, you've got a slash, you've got another number. What does that mean? What is really important to know about adjustable rate mortgages is that they're not really, in most cases, actual true adjustable rate mortgages. They are technically known as fixed adjustable hybrid loans. And nobody could come up with a snappy way to say fixed adjustable hybrid. It's kind of a mess from a marketing standpoint. So the industry has just kind of settled on the convention of describing these loans as ARMs. What makes it a fixed adjustable hybrid loan is the number in the front of that slash. What that number refers to is the number of years your loan rate is fixed. Whether it's 5 years, 7 years, 10 years, your loan, whatever you start with on the day of closing, that rate is fully locked in, no takebacks for the entire number of years as represented in the number before the slash. The number after the slash refers to how often the loan rate adjusts once that fixed rate period is burned up. In our case, most of the programs that I'm going to be quoting to you are going to have a 6 behind the slash. That means that every 6 months, your loan rate will adjust, but again, only after you've gone through the entire fixed rate period on the loan. A couple other technical details with how ARMs work. There is something called a cap structure. Now, the cap structure determines the maximum your rate could ever theoretically adjust up to. You could have a 6% lifetime cap. You could have a 5% lifetime cap. There is going to be some kind of guardrail that makes sure that your loan will never exceed a certain percentage rate, no matter what the market is doing. Next, let's talk about how these rates adjust if you ever are in an adjusted rate cycle on your ARM loan. There is going to be an index associated with your ARM. My bank commonly uses something that I don't know if anybody else pronounces it this way, but SOFR. We use the SOFR index to base our adjustable rate mortgages on. And what this means is if you ever do face an adjustable rate period on your ARM loan that you get with me, that rate is going to be determined on the basis of where that SOFR index is at the time, plus a margin. That is the quick version of this. I didn't want to take up too much time going through the technical details, but if you want to take away anything here, number one, adjustable rate mortgages are not fully adjustable. You got a fixed rate period on the front end. You have caps that protect your rate from going above a certain percentage. Why in the world would you ever consider using an ARM loan versus a fixed rate loan? What adjustable rate mortgages allow you to do is to take, in many cases, a significantly lower interest rate by not locking in that rate for a full 30 years. So essentially, the decision that you have here can be thought of as a trade. With the adjustable rate mortgage, you may have access to significantly lower rates versus the fixed rate program. But what you're giving up is the stability of that entire 30-year fixed rate term. It is that trade that gives you access to the lower rate. There's a million reasons why I can't quote like exact rates that I can offer today and compare it with other things. What I would like to do instead is talk more in general terms. And the relationship between fixed rates and ARM rates, they're going to change with the market like everything else. So on any given day, you could see a really wide gap between the 30-year fixed and the ARM, you could see a smaller gap. But there's almost always going to be a gap between that fixed rate and what you can get on the ARM side. Now, the size of that gap is going to depend a lot on how much of a fixed rate period you want. As you might imagine, from the lender's point of view, if we only have to secure a rate for a short period of time, that's less risk from the bank's point of view as it relates to what we call rate risk on the lender side. So you're almost certainly going to get a lower rate on, say, a 5-year ARM versus a 7, and on a 7, you're going to get a lower rate versus a 10. In terms of how much lower, again, it's going to depend on the day. Maybe on a 7-year ARM, you might see a rate that's 0.5% lower than a 30-year fix. You might see a full percentage point or maybe even a little bit more than that. To give you kind of at least a rough sense of the numbers that we're talking about in terms of how much it impacts your payment, what I did is I did some math based on a $400,000 loan. And let's say in this hypothetical example that by choosing the ARM loan versus the fixed rate, let's say you only save 0.5%. On a $400,000 loan, that translates into a monthly payment savings of $133. If it is a full percentage point, you're talking about $263 a month. Here's my bottom line recommendation. Should you consider an adjustable rate mortgage? I think at the very least, get the numbers. Line up the fixed rate programs with any lenders that you're talking to. Hopefully that includes me. I'd love if you'd give me a call. Line up those numbers for fixed rates. Get the 10-year ARM, the 7-year ARM. If you're not so sure you want the risk of a 5-year ARM, maybe leave that out. But take a look at the numbers for yourself. Make the comparisons for your scenario. And what you really have to do is you have to weigh the benefit of the reduced payments on the front end versus the potential risk of having an adjustable rate loan reset at a time where market rates are going to push it higher. One thing that I've been talking to a lot of people about is trying to look in that crystal ball over, say, a 7-year fixed rate period or a 10-year fixed rate period, and trying to come up with some sort of sense of, what are the chances, number one, that rates are going to be higher at the time of adjustment. 2, and perhaps more importantly, what are the chances that this market kind of turns around toward lower rates over that fixed rate period? And this is one of those predictions, like all predictions of complex financial issues. I wouldn't really give anybody too much credit on accuracy for predicting precisely where rates are going to be. But I feel relatively comfortable saying on, say, a 7 or a 10-year period, the chances that you're going to have some window over that time to snag a fixed rate that's lower or the same as your adjustable rate, I feel pretty good about that bet. But at the end of the day, you're the one in the driver's seat of the mortgage. You're the one writing the check. There is no right answer for everyone on this. And that's why I'm not structuring in that way. I think there are a lot of people that just couldn't sleep at night knowing that 10 years down the road, their rate might adjust. They might not have an opportunity to refinance. I don't want anybody having that kind of anxiety. But if you're a little bit more risk tolerant, I think that you can make a very common sense case for the dollars that you're going to save making the trade to take an adjustable rate mortgage. So the last thing I want to talk about is the bad rep that adjustable rate mortgages have gotten, particularly due to what happened in the lead up and during the fallout of the 2008 financial crisis. If you're talking to your uncle or your dad or your aunt or somebody with hard opinions about personal finance, at the very mention of the word adjustable rate, many of these people are going to say, oh my God, run for the hills. They're crazy. They're predatory. They're bad. Don't do it. Never worth it. Period. End of story. Now, I can respect this point of view. Again, if you're an extremely risk-averse person, don't take an ARM. But there are some differences between the adjustable rate mortgages that are being sold today versus the adjustable rate mortgages that were sold in the lead up to the financial crisis. I could talk for an hour or more on all of the differences, but let's hit the highlights. Prior to the financial crisis, if you took an adjustable rate mortgage, it was actually much more likely that your fixed rate period was going to be extremely short. I saw ARMs back in the day that were 1-year fixed rate period, 2-year fixed rate period. Not only were the fixed rate periods very short, many of these loans also featured prepayment penalty. So even if you have your loan during that fixed rate period and rates drop and you want to take advantage of refinancing out of that program into a fixed rate, what the prepayment penalty did was say, well, you're going to have to pay to get out of this loan. Fast forward to today, the vast majority of ARM programs that are being sold do not have a prepayment penalty. Now, this is, of course, something that's very simple to figure out. Ask the loan officer that's quoting you, does this program have a prepay penalty? In my opinion, it was the combination of the relatively low fixed rate period and the presence of the prepayment penalty that caused a lot of the problems on these adjustable rate mortgages. But you also had a whole other slew of compounding factors. The underwriting standards that were predominant in the years preceding the financial crisis, those standards versus today, to say it's apples and oranges is a super understatement. Mortgage underwriting standards in the lead up to the financial crisis, I don't think this is news to anybody, were extremely lax. You could state your income, state your assets. You could have no job. You could have no verifiable income. You could have a weak credit score and put no money down. Then finally, you have the sales environment of that period of time versus the sales environment of today. In the lead up to the financial crisis, everybody and their brother's cousin was getting into the mortgage industry, selling mortgages that in many cases the loan officer didn't understand, pushing papers over to a client that of course cannot be bothered to read this kind of stack. You had blind leading the blind with products that had crappy underwriting standards, that had terrible features for the consumer. Of course, all of this stuff together was not going to lead anywhere good. If you fast forward to today, the mortgage underwriting standards on adjustable rate mortgages are a little bit more strict than they are on the fixed rate mortgage side, and for good reason. To tie everything together, adjustable rate mortgages, I like them. They're really good for the right candidates, particularly if you're somebody that is not planning on living in the home beyond that fixed rate period. Hey, you get the benefit of that low rate, and your risk of ever facing adjustment, based on your plans anyway, are significantly reduced. So why not save the money in that case? There's risk associated with everything. Taking on a 30-year fixed mortgage, there's a risk there. Taking on an adjustable rate mortgage, we can say that there is more risk associated with that. But ultimately what it comes down to is you in the driver's seat of your financial destiny, weighing the pros and cons of the risk versus the reward to see if an adjustable rate mortgage will help you reach your goals. Well, I hope that you found this quick primer on adjustable rate mortgages useful. If you would like some actual numbers from me on my super competitively priced adjustable rate mortgage options and my standard fixed rate programs, I would love to talk to you. I work with people all around the country. I've got clients spread out all over the place. I've got realtor relationships all over the place. I do good work. I'd love to earn your business. Let's talk about your mortgage needs. Let's get some numbers into your hands. I've got some cool calculator tools. Call me at the number below or text me there anytime. I'd love to hear from you. Thank you so much for watching. We'll talk again soon.